Mantengu Mining has revealed its purchase of a cutting-edge iron plant in Phalaborwa, Limpopo for over 18 million rand. This acquisition was finalized through an agreement with the joint liquidators of Masorini Iron Beneficiation. In July of 2024, MIB was placed into final liquidation, which prompted the appointment of the joint liquidators, who then took on the responsibility to auction those assets. So that's the backdrop. Let's talk now to Mantengu Mining CEO Mike Miller to talk about the impact of this investment and its prospects for job creation. Mike, good morning to you and welcome. I want to say congratulations on the acquisition. Just tell us a little bit about the acquisition itself and why you went after this part of the business. There were multiple assets on auction.
Yes, good morning, Iman. Great to be here. For us, it forms a major part of our metal strategy as a group. And if we look at that strategy at a macro level, the world is obviously in a massive flux given all the geopolitical uncertainty. The demand for steel remains fairly robust and is expected to be boosted post-war developments in both Europe and the Middle East. And there's significant pressure from an ESG perspective being placed on extractive industry and banking and finance industry. So for us at a macro level, our view is that metals need to form a huge part of our investment strategy. And at a micro level, every investment needs to really tick two boxes. One is that we want to be a low-cost producer, which is obviously critical to get through the dips in any market. And the second one is our investments need to be ESG friendly, and this certainly is. The reason we targeted it is an innovative iron production plant. It produces high-value metallic iron at a very low cost, and it ticks a number of the environmental issues, as it's one of the most environmentally friendly processes out there.
Yeah.
So we're hugely excited about the impact to our business and to the local area in Phalaborwa.
As you say, the strategic cut and thrust is around being a producer of high-quality products at low prices, low-cost metallic iron. But if we go back to the acquisition itself, MIB had reported a negative equity of around 203 million rand, 10 million rand losses was according to their last audited financial statements. But you and your board are expressing optimism. So how confident are you that you can rehabilitate, not only rehabilitate, but grow and expand the business and modernize the business as per your strategic objective?
I think the first point to make is that we're hugely excited and confident in the investment. We've been watching this business for a very long period of time. And I think it's important to point out that the numbers you're referring to from an annual financial statements perspective reflect a development balance sheet. And this business only went into liquidation just as they were about to start hot commissioning. And the liquidation itself had nothing to do with the technical capability of the plant, but rather the difficulty in the relationships between management directors and the shareholders. So from our perspective, those numbers aren't reflective of what we believe the value to be. The second element is that the novelty in the plant has been proven. And as a result, we don't see that as a risk. And our current focus is to increase availability and then obviously work on the efficiencies of the plant going forward. So from our perspective, we believe we have acquired assets out of a distressed company with massive intrinsic value, and we look forward to capitalizing on that going forward.
Speaking of which, let's talk then. I mean, and we have seen, the waxing and waning of prospects and opportunities, particularly in the steel industry in South Africa. Recently, ArcelorMittal has been winding up its long steel business. And the reason it did that, it said, was to prevent a drag on other aspects of its business in South Africa. We saw also its share price go down by 2%. After the imposition of those steel tariffs that coming out of the US vis-a-vis Donald Trump's new executive orders, and 3,500 jobs on the line there. So you see, mining towns, steel mining towns that are dependent on these businesses for their lifeblood at risk of just dying. You think of Newcastle and you think of Vereeniging. So it's against that backdrop that I'm asking the next question, which is, again, you say you've got a hot prospect. It wasn't because there were problems with the actual plant itself. So you've got a viable business. How many jobs are you likely to create out of this, or will you go after those who were already working there And can you keep this sustainable in the long term?
Yes, I think it's probably worth just mentioning that we aren't a direct comparison to ArcelorMittal. The business that we're acquiring and the product it creates would be a feedstock for the big steel producers. So just to say we're part of that value chain, but not a direct comparison. I think the advantages of this plant and business are that the plants themselves are modular. They require low energy. And as a result, we have the ability to place them at source. As I mentioned to you before, there isn't a technology that converts superfine iron ore into saleable product. So you have massive rehabilitation liabilities scattered all over the world. Because it's energy efficient, we aren't hugely reliant on the availability of Eskom power. And as a result of all of that, we can place these plants in areas where we guaranteed a much lower production cost. So I think from a sustainability perspective, we're confident that the production cost, the rehabilitation impact will allow us to operate through difficult times in the market. As a result of that, and given the modularity of the plants, we expect to create about 35 to 50 jobs per plant. We would like to build 10 new plants in Phalaborwa as a starting point. And as a result, we can see this ramp up hugely. And I think the other point just to note is that we are selling product into a market where we aren't even a player. We won't even move the needle. So from a market penetration perspective, there really isn't a risk, and we can scale up without standing on any of the opposing toes.
And I think that's useful context as well, Mike. Thank you very much for that. And I guess when you start up or you continue that operation then in Phalaborwa, which, as you say, is a modular business, so you can kind of place it anywhere, which gives you that ability to be agile. You'll probably see where there might need to be a tweak here. A tweak or two here and there, I guess, in the business model itself. You can come back on that one, but I also just want to ask, just in terms of the product itself, as you say, you're part of the value chain, so you're not playing quite in exactly the same space as ArcelorMittal, and so the risks would be very different from your position in the ecosystem of South Africa's markets itself. Just share with us where some of these products go and what they actually do. I should have asked that at the very beginning. We can't make assumptions. I might not know as well exactly where what you're providing goes and how it actually fits into the ecosystem in terms of what's beneficiated at the end.
Perfect. Iron is one of the major inputs in the steel making process. So for us, the markets are local markets where we can produce a feedstock for the steel makers at a particularly or a much lower price than they're available to get elsewhere. And then from a steel perspective, the two major players really are China and the US. So the vast majority of this product would probably land up going to China. And if you look at our other investments, we've got several investments in the chrome space. Chrome is what makes stainless steel stainless, and all of that product goes through to China. I think we're bound to see some market changes given the geopolitical arm wrestling between China and the US. But I think the beauty about our business is that we're agnostic to market, and we're selling a product that's agnostic to territory. So for us, we're hugely confident that we can move our product into the local Chinese and US markets pretty easily.